What if I told you that most Americans are leaving tens of thousands of dollars on the table every single year? Not because they're bad with money, but because nobody told them about the rules of the game. The tax code, the investment vehicles, the employer benefits, the compounding plays. They're all right there, written into law, available to anyone willing to learn. And yet the majority of people ignore them entirely. In this video, I'm giving you 7 concrete money moves that every American should be executing right now. While specific windows are still open, some of these are time-sensitive. Some will feel counterintuitive. All of them are backed by real numbers. Let's get into it. A health savings account is the only triple tax advantaged account in the entire U.S. tax code. You get a tax deduction on contributions, tax-free growth, and tax-free withdrawals for medical expenses. In 2025, the HSA contribution limits are $4,300 for individuals and $8,550 for families. If you're 55 or older, you get an additional $1,000 catch-up contribution. Here's the move most people miss. You don't have to spend your HSA money on healthcare now. You can invest it in index funds, ETFs, almost anything, and let it compound for decades. Then at 65, you can withdraw it for any reason, treating it like a traditional IRA. For medical expenses, it's tax-free forever. If you're on a high-deductible health plan and you're not maxing your HSA, you are leaving free money on the table. Here's the thing about taxes: rates change, and right now we are in a historically moderate tax environment, but that window may not last. The Tax Cuts and Jobs Act provisions are set to expire at the end of 2025 unless renewed. That means tax brackets could revert to pre-2017 levels for many Americans starting in 2026. The smart play: if your income is temporarily lower this year, maybe you changed jobs, took a sabbatical, or had a down year in your business, convert as much as makes sense at your current bracket. A financial advisor can help you model the optimal amount. But the concept is simple. Pay taxes on your terms, not the government's. Direct Roth IRA contributions phase out at $150,000 for single filers and $236,000 for married couples filing jointly in 2025. But there's a legal workaround that high earners have been using for years: the backdoor Roth. Here's how it works. You make a non-deductible contribution to a traditional IRA, up to $7,000 in 2025, $8,000 if you're 50 or older, and then immediately convert it to a Roth. You've effectively funded a Roth regardless of your income. If any of your investments are sitting at a loss right now, congratulations, that's actually a financial asset. Tax loss harvesting means selling positions at a loss to offset capital gains elsewhere in your portfolio. If your losses exceed your gains, you can deduct up to $3,000 against ordinary income per year and carry forward any remaining losses indefinitely. In volatile markets, this is one of the most powerful tools available to investors. The key is understanding the wash sale rule. You cannot buy back a substantially identical security within 30 days before or after the sale or the loss is disallowed. Most people think about what to invest in. The smartest investors also think about where to hold those investments. Asset location is the strategy of placing different types of investments in the most tax-efficient accounts available. The basic principle: hold tax-inefficient assets, like bonds, REITs, and actively managed funds that generate ordinary income. In tax-advantaged accounts like IRAs and 401ks, hold tax-efficient assets, like index funds and growth stocks you plan to hold long-term, in your taxable brokerage account, where they'll be taxed at lower capital gains rates. This is the one that changes lives and people don't talk about enough. Geographic arbitrage means deliberately choosing where you live or work to maximize the gap between what you earn and what you spend. If you earn a New York or San Francisco salary while living in Houston, Raleigh, or Tampa, or if you're a remote worker living internationally, you can dramatically compress your financial timeline. Someone saving $5,000 per year in San Francisco might save $25,000 per year with identical habits and income in Houston. The math is not subtle. With remote work now a permanent fixture of the American economy, geographic arbitrage has become one of the most powerful and underutilized financial tools available to knowledge workers. Run your own numbers. The results might shock you. This one sounds simple because it is, but it's arguably the most impactful move on this entire list. Research consistently shows that the single biggest predictor of long-term wealth is not investment returns. It's savings rate. The more you consistently save and invest, the wealthier you become, almost regardless of what the market does. The behavioral trick: increase your automatic investment contribution by just 1% of your income right now. Set it up so it happens before you ever see the money. Then do it again in 6 months, and again. 7 moves. All of them legal, all of them available to you right now, and all of them time-sensitive in different ways. The Americans who build real wealth aren't the ones who found some secret investment. They're the ones who consistently execute the fundamentals at a higher level than everyone else. If this was useful, subscribe. We put out financial strategy content weekly designed for people who are serious about building wealth. Take care of your money. It's the only one you've got.